Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, I'm thrilled to be joined by Head of Fixed Income Research and Managing Director Tom Tzitzouris. Tom, how are you doing this morning?
Excellent. It's a pleasure to be here.
Yeah, great to have you. Well, and it's fortuitous, the timing as well. We're recording on a Thursday. The Fed had their meeting and Fed Chair Powell's press conference yesterday, where they outlined both the timeline for tapering, their thoughts on inflation. Let's just keep it high level. What's your big takeaway, and maybe react to how bond markets moved in the aftermath of the press conference?
Yeah, well, the big takeaway is for now, no surprises from the Fed yesterday. They're deciding to taper Treasury purchases by $10 billion a month. They're reducing mortgage purchases by $5 billion a month. Next month, they're going to reduce it again, another further $10 billion and $5 billion. If there's a little wrinkle here, it's that they're going to pause their decision-making in January, and they may either accelerate the pace at which they're reducing purchases, they may hold it steady, reduce them another $10 billion and $5 billion a month, or they may reduce it. But they're setting up intentionally right now a pause in the decision-making process. We believe the reason why they are setting up a pause in the decision-making is because they're actually considering accelerating the pace of tapering, maybe accelerating that to 20 billion a month of treasuries or 15 billion a month of treasuries. And that's kind of a shout out to the reality that we have a higher level of inflation than they expected to see right now, and also quite a bit of inertia to that. The other key point is that they did a pretty decent job, that is particularly Fed Chair Powell. He did a pretty decent job of separating the idea of tightening, that is rate hikes, from tapering. And one way you can see that in the financial markets is that 2-year yields are down more than, say, 10-year yields or 5-year yields. So the curve is steepening as the market is pulling some of those rate hike expectations out of 2022. It's important to note that heading into yesterday's Fed meeting, the market was pricing in roughly 2.5 rate hikes for 2022. What that means specifically is that the market was starting to price in a possibility that the Fed tightened in June of next year as soon as tapering was expected to be completed. Now the market has taken some of that rate hike expectation out and kind of pushed it further into 2022 later. So the Fed has had some success, we'll say, in separating tapering from tightening. But the big difficulty they're going to have over the next few months is the market is going to want to continue to pull forward those rate hike expectations. The Fed's going to want to push them back. And how they taper and how they communicate that tapering is really going to determine whether or not they're successful at pushing back those rate hike expectations.
Yeah, I thought that was interesting as well. And Fed Chair Powell did a pretty good job of separating those out. He also talked about the potential for an uncertain inflation outlook until Q2, Q3, an uncertain employment outlook until Q2, Q3. He really seemed to be setting up this kind of optionality for the Fed to wait and see. With that said, we have a non-farm payrolls report tomorrow. We get another month of jobs data. What are you looking for there? And could that be the first domino to fall, funnily enough, in the idea that they might be a little more aggressive with tapering once 2022 gets going?
Yeah, at this point in time, I would say, being a bond guy, I'd focus entirely on the average hourly earnings number in tomorrow's non-farm payroll. And really what we want to see is are wages accelerating? Because an acceleration or a further push higher in wages is really going to tell us that this inflationary pressure that's been building, it has legs to it. That's how you get a wage price spiral. If wages are rising with inflation, then you can accelerate inflation even further. That's what I think the Fed is going to be keeping an eye on. That's what we're going to be watching as well.
Yeah, it was interesting because Fed Chair Powell was pretty nondescript with the bank's definition of maximum employment, but they certainly want something that resembles pre-COVID, if not an improvement on that, and we still have ways to go there. So, do you buy into the idea that a wage price spiral is a realistic outcome from what we're seeing? Some of the inflation readings have started to temper a bit. They still remain highly elevated, and it's still a concern, but watching that number, is that a big concern to you all, or do you see it more on the supply side? And once that gets worked out, inflation might moderate a bit?
Yeah, I'm going to be quite candid on this. I think we're already in the midst of a wage price spiral. I think, and I've been telling clients, I've been telling the press that, really what we had throughout the year was a production bottleneck that became a production and a distribution bottleneck. Now we have a production and distribution bottleneck with the labor bottleneck as well. It has hit all factors, all points in the distribution and production channel. Now it's in labor. The fact that it's in labor right now tells us that laborers, people who work for a living, people who go out there, high income, low income, they all believe they have pricing power. Once they believe they have pricing power, it's pretty much game over. The inflation has legs to it now. That's my honest opinion. It does not mean that we're going to see an acceleration higher in inflation. It just means that this inflation is now going to be sticky and not transitory. Now, we never thought it was going to be transitory in the first place. But to me, sticky means this is going to be with us for perhaps the entire decade. Forget about the next few quarters. We could be looking at 3% plus CPI for the next decade, certainly for the remainder of this business cycle. I think the Fed knows that. And I think that's what you're going to see in the non-farm payrolls tomorrow, is that wages continue to rise towards where inflation is. As long as wages are rising towards where inflation is, that tells us that the wage price spiral is still in effect.
That's fascinating. Well, and if you look around the country, anybody who's been to a restaurant or been anywhere, you can see the labor shortages. The stories about strikes and unionization are popping up more and more. So it's a great observation, and it's really good insight for folks who'll be watching non-farm payrolls report and who will be watching the Fed over the next year. So I can't thank you enough for the time. It's been super insightful, and we'll look forward to talking to you again soon, I hope.
My pleasure. Thank you for having me.
Thanks.